Get ready for more valuable financial insights from Northern California's premier retirement income planners, Dan Ahmad and Jim Files, owners of Peak Financial Freedom Group. For more information, go to peakfin.com. And now, here's Dan and Jim.
We'd like to welcome you all to the Peak Financial Freedom Hour. You're here with Dan Ahmad and Jim Files, and we're going to give you a ton of information today, like we do every week, to hopefully help you make better decisions about planning for retirement. This show is not for the young people. It's not for the 20-year-olds, the 30-year-olds, or the 40-year-olds. It really is for the 50-year-olds and up. From 59 on is really the type of people that will get the most out of the show. So we just let you know right off the bat. We'd like to thank everyone for listening to us. We have a lot of new listeners right now coming in on a weekly basis, but we have a ton of old listeners that have been here listening for a year, 2 years, 5 years, 10 years. We have a lot of our current clients listening. So it's kind of nice to be able to have all the people there. And you can do other things with our data as well. You can listen to our podcast right off of our website, peakfin.com. You can go to our YouTube channel. You can go to our website and look at all kinds of educational videos and download our most recent best-selling book, Mama's Secret Recipe for Retirement Success. And make sure if you find that you think you need help as we're going through all the different subjects we cover today on the show, call us. We'll do a free consultation on the phone and then find out if what you need can fit with what we can provide, and it doesn't cost you anything, and there'll never be any pressure. All you have to do is dial pound 250 on your cell phone and say the keyword money. That's pound 250 and money. And if we build a plan, we actually will give you a free written retirement income plan without any obligation to do business with us. So make sure if you need help, give us a call. What I'd like to do, Jim, if we could, let's start with you giving what we think would be the number one quote of the week.
Well, this comes from Jim Rohn. He's a motivational speaker, and he says your income is directly related to your philosophy, not the economy. Again, your income is directly related to your philosophy and not the economy. And, you know, Dan, that's a great, great quote because philosophically, as a pre-retiree or a retired person, you have to decide, do you want to go to retirement based on hope and luck? You hope it works out, and if you're lucky, maybe it will work out. Or do you want to go through retirement with a disciplined plan in place, an income plan, a tax plan, a legacy plan, a risk plan, a fee plan, telling you architecturally exactly what you have to do and how your money should be positioned to give you the highest probability of success? And you do get that choice. So that quote's perfect, Dan, because we talk to people every day when they come into our office for the first time, and we ask them that. How do you want to position your retirement? You want to hope it works out, or you want the highest probability that it will work out?
Well, I think that statement you just chose the exact perfect quote of the week for the first subject we're going to talk about, and that is what most people call accumulation versus decumulation, which sometimes people don't even know what that means. We call it stage 1 versus stage 2. But if you just go back to the basics, things you're talking about as far as the philosophy of your money and your assets has to be one of two things. And you really can't do both. As far as max out one or the other, you either have to have maximum growth or you have to have maximum income. And you can do a little bit of both, of course, that will blend it, but you have to decide what is your philosophy. So what is your number one philosophy that gets the majority of your attention? Is it going to be growth or is it going to be income? And while you're working, you're young, you have time on your side, you can make up losses, then it really should be positioned as much as possible for growth as possible. At retirement, what's going to give you the most success in retirement is going to be specifically how much income you can generate. And it's not just income, but it's dependable income at the highest level that's guaranteed for as long as you live. And if you think about it, it makes 1000% sense. No one can argue about it. The problem is so many people, there's so many advisors, so many people on the radio are talking growth. Oh, hang in there and write it out. You'll be okay. Oh, you can take income off of it and don't worry, it won't run out and everything's going to be great. And you can leave $10 million to your kids. And when you think about that, when you talk about accumulation versus decumulation, what comes to your mind as far as just the most important things for people to know?
Well, again, you know, Dan, as you mentioned, as you get close to retirement or in retirement, particularly when you choose to no longer work, you're not going to have any income coming in from any type of source other than your investment, Social Security, and maybe you're lucky enough to have a pension or maybe you have some rental income, but your assets are your paycheck. So you have to decide, do you want to continue to risk those assets like you've done for the last 35 years when you weren't retired at the same level and have ups and downs. And matter of fact, there was an interesting chart that we put together here recently. If you go from October of 2021 through April 4th of 2025, when the market declined here about a month and a half or 2 months ago, the market was almost flat. The Dow, the S&P 500, and the NASDAQ. So in other words, if you retired on October of 2021 and you rode out the market and you were taking out 4 or 5% in distribution, when you woke up on April 4th, not only was the market flat, but you would have taken out almost 4 years of distribution of 20%. You were probably down 15 to 20%.
Plus fees.
Plus fees.
So you might have been down 25%.
Yeah. So people have to realize that, but everyone gets indoctrinated by the data coming off the internet, what the big brokerage companies are telling you, what your advisor is telling you, is that you have to continue to invest for growth. And it's not that you won't have growth in your portfolio, but you have to decide, as you mentioned, Dan, is you have to dedicate your discipline toward, do you want to take risk and lose money with the hopes you'll make money and take out money at the same time to live? Or alternatively, do you want to preserve those assets that took you 40 years to save and make sure you have maximum income coming off those in retirement? And that's your choice, Dan. That's the consumer's choice.
Exactly. But they don't know it's their choice because 99% of them are being handed the same line. Invest in the stock market. It's the only way you'll be successful in retirement. You're going to get huge gains. Don't worry. You can take income that won't run out and everything will work out. The problem is we don't know that for sure because with a volatile market, in retirement, do you really want to go through what's happened since 1929, where the stock market goes down almost 40% every 5 years? So if every 5 years historically, since 1929, it's happened, you better plan not that it's going to happen. You better plan that this could happen, and you have to make sure your assets are allocated properly so those almost 40% losses don't hurt you. And if you're taking income out, a 40% loss every 5 years isn't just going to hurt you, it's going to kill you. It will significantly decrease, if not completely eliminate, your chance for successful retirement. So that's why you have to look at what's going on really right now in your lives and how you have to view your money. And that comes down to looking at what people call the accumulation mode of retirement, which we call here at Peak your stage one, which is accumulation for retirement. And that's when you're working, you're young, you're making a salary and you make more money than what you're spending. So you really don't worry too much about a budget. You're willing to take as much risk as possible to get the highest rate of return, and you're okay with volatility and losses because you have time on your side to make it up, and you don't need the assets for income because you're making a salary. So that's basically where people are at almost their entire lives because the advisors they work with, especially when they're younger, focus on growth. The issue is you cannot take that philosophy of investing into retirement and hope that you're going to have an extremely successful retirement, because the higher growth you go for, long-term, you'll probably get a higher rate of return, but in retirement, the significantly less amount of income you can take out of the assets because you have volatility. So then you have to transition over to what's called decumulation, which people want to know what the heck that means. We call it stage 2, and we call that asset accumulation and income distribution. So maybe talk about what stage 2 is about. We talked about stage 1 as far as accumulation, risk, not worrying about it, hanging there, write it out. Now, why does a retiree or someone getting ready to retire in the next 5 years, why do they have to worry about stage 2, asset preservation and income distribution?
Yeah. So it's asset preservation. I mean, it's pretty clear when we say asset preservation. What that means is that you have to figure out, as a consumer, as an investor, how do you preserve the assets that took you 35 or 40 years to save? And you have to make sure you do not make a financial mistake at that point in your life, because if you do, there's a good chance your retirement plans are not going to work out the way you dreamed them to work out. So number one, you have to figure out how to mitigate the risk within your assets to make sure that you do not lose a lot of money when the markets go down. Because as you mentioned a minute ago, Dan, every 5 years on average since 1929, the market go down about 40%. But if you look at what's happened since 2009, we've only had one major crash. So we're way, way, way overdue for a market crash of 40% or greater. So, for example, if you're 60 and you live till 90, that's 30 years, every 5 years, there's a market crash on average. Take 5 into 30, you're going to see 6 of them. Maybe see 5, maybe see 7, but you better have the data in place because you have to preserve your assets against those types of drawdowns in a market. So the second thing is income distribution. Income distribution means that you have to replace your paycheck in retirement, and you have to figure out how to get dependable or even guaranteed income that will last your life and your spouse's life if you're married. And there are very specific products that will do that. But number two, you can't do number two unless you do number one really well. You have to make sure you preserve the assets against a market drawdown or major risk so that you can get the income. So maybe we can talk about that, Dan.
Sure. Income at retirement is the single most important part of creating a plan, because income will specifically drive your lifestyle. The more income you have, the better lifestyle you'll have. The less income you have, the lower type of lifestyle you have. And when you look at it, most people at retirement do exactly opposite, and they're advised to do exactly opposite of what will give them the best, happiest, most secure retirement. They're advised keep it in the market, use it a little bit at a time, don't take too much money, or even IRAs, worse, wait until you're 73 to be forced to take your money out. What you want to look at is the assets you built. And the reason you started saving them 20 or 30, even 40 years ago was to build up a high value pile of assets so that you could use to create the highest level of income for as long as you live that won't run out. And if you did that, you'll be safer. The problem is now at retirement, so many people who become good savers are very, very, very afraid, almost unwilling to spend their money because it seems like it's exactly opposite of how they got here. They're a saver, saver, saver. Well, you saved it so you could spend it. You didn't save it to now hoard it and worry more about it now than you did before. You saved it so you could worry less. So the only way you will decrease your amount of worry is to create income that's contractually guaranteed to be paid to you for as long as you live, and it better be at the highest level of income you can get off of any type of asset right now. You're back with Dan Ahmed and Jim Files, the Peak Financial Freedom Hour, and today we are talking about decumulation versus accumulation. And decumulation sounds negative. It sounds like something you don't want to do. But when you look at how we explain it, asset accumulation is when you're young, working, and you are saving money towards retirement, and you can be as aggressive as you want. That's stage one. Decumulation, we don't call it that. We call it stage two, which is asset preservation and income distribution. And if you think about it, if you're retired or within 5 years of retirement, do you want to protect all your assets against large losses? And the answer better be yes. And you want to create the highest level of income as long as it won't run out for as long as you live? And the answer better be yes. So those are the two things stage two is focused on. And we kind of went through the combination of here's what stage one is, here's what stage two is. The key, though, now is to be able to put a plan together in writing that will do this, because you can't just allow your advisor to say, don't worry, you don't have that much risk, you can't lose much. Okay, well, that means you preserved your assets against large losses. But if it's verbal, it doesn't mean anything. It's meaningless because no one's put it in writing to prove it, and no one then is accountable or responsible for it. So if you're going to reduce the risk or eliminate the risk of large losses, you have to get that in writing from your advisor, or if you're doing it yourself, you have to put it in writing for your spouse to say, yes, this is the amount of risk we have. We can't lose more than a certain amount. Some people are coming in right now and they say they don't want any risk at all. And that, if that's the case, you have to get it in writing that if the market crashes like it did in 2008, you don't have any risk. The next step then after creating that asset preservation, because asset preservation will allow you to take out more income. Because if your account falls 50%, like it might have in 2001 and 2 or 2007, 8, 9, how much income can you really take out of that? And the answer is going to be zero. If it goes down 50%, you have to wait for it to recover before you start accessing it again, which means you better not ever let yourself be in a position to lose 50% or 40% or even 30% in retirement. Now the goal is, once we turn out that income, we want it to be as high as possible, because all of us have seen bank rates go down drastically over the last year or so. And we got so used to getting those really good rates. Now they're starting to go down. We have to make sure we can lock in whatever payout rate you're going to receive from your assets, not for a year, 2 years, or 5 years like a CD, but for your entire lifetime. Because we can get a high income payout rate guaranteed for life. What's that going to do to someone's plan?
It's going to change your life. You're going to stop worrying about your money. You're going to be able to do the things that you dreamed of doing when you weren't retired. You're going to be able to have cash flow to do things extra in retirement. You're going to be able to replace your paycheck. And in many cases, you might be able to generate more income than you did when you were working. That seemed really odd, but these financial instruments are very, very powerful. And they allow you to have a contractual guarantee that your income will never go down for the rest of your life. You'll never lose a penny if the stock market crashes. You'll never lose any money if interest rates go up or down. And if you live to 100 or 110, they have to continue to pay you. Now, you don't put all your money there. What you do is you design a plan whereby you put enough money there to get you the income you need on a guaranteed basis for your life, and if you're married, for your spouse's life. Then you can invest for growth. You can invest your assets in volatile asset classes like stocks and some bonds and real estate and gold and silver and commodities. You can do all that stuff, but you have to take care of your income first, because income is priority in retirement. You want to make sure that all of your income sources that are going to maintain your budget and inflation are guaranteed. So, for example, just say you have a budget of $8,000 a month. And let's say cumulatively between you and your spouse, you have $5,000 a month in Social Security income. You don't have a pension. You may not have any rental income. So you have an $8,000 a month budget. You have $5,000 coming in that's guaranteed from Social Security. You're short. You're short $3,000. And on top of that, if we have inflation of 3% every year for the next 30 years, you're going to be short even more. So the theory is you want to have enough guaranteed income at a minimum to maintain your budget along with inflation and excess cash flow above that amount that you want to spend above your budget. So it's real simple when you start to look at the math. You said, okay, $8,000 a month. I'm short $3,000 because I have $5,000 coming in from Social Security. I put enough money for that. I have to calculate inflation, put enough money in to cover inflation, and then I have to calculate how much excess cash flow I want above the budget to do the things that we dreamed about in retirement, and you put enough money to do that as well. Dan, if they do that on the basis, their life will change.
100%, because what you just explained is the only way people can stop worrying about their money is by making sure, guaranteeing that they have more income coming in than what they need to spend, and they have excess. And people always wonder, well, what does that mean? I think when we meet with new potential clients, they all think if they're lucky, they can hopefully bring home close to the same net income they were bringing home when they were working, because they knew that worked. A lot of them think they're not going to bring enough income home. And our clients are all very successful people. Average client has between $1 million and $10 million of assets, not including their real estate. And I'd say the typical client has between $1.5 million and $3 million of assets that really needs help. And all of these people, literally every one of them, thinks they haven't succeeded. They think that they have fallen short. They think they haven't saved enough. They think they made mistakes. They think there's no way retirement's going to work for them. And when we do a plan for them, if you're in that group, you probably have a 90% chance that your plan's going to work. I'll give you some examples. I just met with a new potential client, designed a plan, and she works in the medical field. She makes about $200,000 of gross income, but after taxes, Social Security, her 401k, 403b, all the things she's doing, she makes $200,000, but she nets $8,900 a month. And she was hoping we could get her to an $8,900 a month net income. Well, I was able to create a plan that gives her $13,000 of net income after taxes per month, with her immediately retiring now, not working later. So she's going to have $4,100 more per month than her current net income, which means what? It means her retirement is going to be successful. Another client came in, single person, had $7,000 net income, made about $150,000 a year, netted $7,000, and they were hoping to get about $7,000 to $7,500 in net income. We built a plan that gives them $10,000 a month of net income after taxes, $3,000 more than they had. So it was awesome. Another client came in. It was a couple, and they were both working. They made about $230,000 between them. After all the deductions, 401k, etc., they netted right at about $11,000. And they wanted to try to get up to $13,000 a month of net income. We were able to create a plan that gave them $20,000 a month of net income after taxes. What does that allow them to do now? They have $100,000 more to spend in their budget. How do they feel, and what does that allow them to do? You're back with Dan Ahmed, Jim Files, the Peak Financial Freedom Hour, and we are talking about the difference of saving for retirement and then using those savings to create income that will never run out. People call it accumulation versus decumulation. Here at Peak Financial, we call it stage 1, asset accumulation when you're working, versus stage 2, asset preservation, income distribution. And Jim, we were just talking about at the end of the last segment how we've created significant amount of income above what someone's current net is. Because most people feel if they can get their current net, they can probably retire okay. Maybe not live lavishly, but at least pay for the exact same things they were paying before. So typically we'll increase someone's net income by $3, $4, $5, $6, $7, even $10,000 more than what their net income was before after taxes. And if you do that, what is that now allowing them to do that maybe they never even thought they were going to be able to do?
Well, first of all, that last comment is true. Most people don't believe they could ever get to that point where they're generating more net after tax cash flow in retirement than they had when they were working. And the examples you gave earlier before we took the break were three different examples. If you have $1 to $3 million in assets, there is probably an 80% chance, I'm guessing, maybe even greater, that we can generate greater cash flow than what you're getting right now. If you're working, right? So if you're making $150,000 to $200,000 a year, and you have $2.5 million of assets, there's a great chance we can get more cash flow. Almost
because of how much are they losing of their 150 or 200,000 in Social Security tax, federal state tax, plus 401k contributions?
Yeah, exactly. Because your 401k contributions is probably $30,000 a year, and then you're paying payroll taxes, you're paying other expenses that you don't have when you're retired. So all of a sudden, you have more cash flow to work with. And if you take your assets, there are certain financial instruments today where you can get a distribution rate, not interest, but a distribution rate, an income distribution rate of 6, 7, 8, 9, even 10% per year on your assets, depending on how long you defer. So if you're getting 8% on $1 million, that's $80,000 a year, Dan, $80,000 a year in cash flow, along with your Social Security. And then you have other assets to invest, maybe in growth assets where you're taking a distribution. When you add all this up, you can change your life because you will be able to have enough income. In many cases, Dan, people come in and say, gosh, I can't believe this. I have more income now than I ever had when I was working. How is that possible? They say it all the time. How's that possible?
Well, there's a couple reasons for that. One of the big ones is if you look at what's happening now, one of the examples I gave before the break was a client just worked with. She makes $200,000. So that's about $18,000 a month gross. But after Social Security taxes, after putting money into her pension, after putting money into her 401k, after federal and state taxes, she nets per month $8,900 a month. And this is going to sound familiar because it's about half. Typically, most people net, after all the deductions while they're working, about half. Well, one of the first things we want to look at doing then is at retirement time, what's going to happen? Will we lose half? Because everyone thinks they're going to lose half. At retirement time, the average client that we work with is going to only lose between 15 to 25%, even at the high level of their total gross income to arrive at their net income. So let's say with this particular client, we now created a plan where we're going to gross not her $18,000 a month, but we're going to gross $16,000 a month because of her Social Security pension and using income from her assets. Well, if you look at $16,000 and only netting half of it, she thinks she'd only net $8,000, which is close to $8,900. But in reality, she's going to net $13,000 a month after taxes because she's not going to be paying into Social Security. She's not going to be putting money into her pension or the $30,000 into her 401k. So that all comes to her. So it means she's only going to lose that $3,000 of expenses, not $8,000. And now she can live on $13,000 on a monthly basis.
And that's a great point because if you look at the majority of clients that we meet with, I would say over 80% of them are netting 80% of their gross cash flow net after tax. After retirement.
But before retirement, what was it?
Half, 50%. And that's amazing, right? And the software that we have that we use here actually shows you that. It'll say 19.1% of your money is going to go to the federal and state governments, and you're going to keep 81% of your money. It actually shows that to you. And it's mind-blowing to people. I said, well, how's that possible? As we mentioned earlier, because you're not making contributions to your 401k, you're not paying payroll taxes, and all of a sudden, all that money comes back to you. So you can, in many cases, generate more net cash flow after tax than you ever did when you were working, which might blow people away.
Well, think about it. If you're this lady that we worked with, and she was netting $8,900 right now, and she's in the medical field, and so many people in the medical field have found it very difficult from COVID until now. More stress, less help, more work on them. Just terrible. And she loves her job, but she's so stressed by it. And she's 62. She thinks she has to work to 70. So we did the plan and we showed her, okay, you can keep working and make $8,900 a month net income, which fine. She can survive on that. Or you can retire today and make $13,000 a month of net income after taxes. And she said, well, that seems to be a no-brainer, but I feel responsible for my job. But she's so stressed. She literally has a tick in her eye. And she told me that. And I'm looking at her, and her eyes going, because she's so stressed because of work. So I told her, okay, let's look at it this way. You can continue to work, keep doing it, keep having the tick in your eye, keep being stressed out, and pay your employer $4,100 a month to work there. Because if you retire, you're going to get $13,000. If not, you work, you make $89,000. That means you're willing to take $4,100 less income to continue to work there. So you must really love your job. She goes, no, I don't. I'm stressed. I said, okay, then if you retire, you're going to get $13,000, which is a $4,100 monthly increase.
Yeah, it's mind blowing what people actually, how they react when you see this. But also, a big consideration is that you have to divide your money up in different asset classes, because we can't do that if you just put all your money in the market. We can't do that because the safe withdrawal rate is 3%. We have to introduce different financial instruments that are going to pay a higher distribution rate to you on your money, guaranteed for life. Not that we're not going to take money off your managed portfolio in the form of a distribution, but we're relegated to take out a lot less. These instruments we're talking about will pay you a lot more guaranteed. So you have to integrate different strategies to make this work, Dan.
You're back with Dan Ahmed, Jim Files, the Peak Financial Freedom Hour. Thanks for staying with us. Today, we've been covering what's called asset accumulation and asset preservation with income distribution. And that simply means stage one of retirement planning while you're young, working, making a salary, have time on your side, versus now either retired or within 5 years of retirement. You can't wait until retirement to then transition your portfolio from something very aggressive into something a lot more conservative, because if anything happens over that 5-year time period, there's a high probability you're not going to be able to retire as planned, or not be able to retire with the amount of income that you wanted. So there's a couple points that I like to talk about. One is risk, because the more risk you take as you've been accumulating assets when you were young, the higher rate of return probability-wise you were going to get. But that no longer works at retirement. The higher risk you take, the lower amount of income you can take from your asset base as a percentage, simply because volatility decreases the amount of income. The less volatility, the more income as a percentage base can we take out. Let's look at an example of the client. I've been talking about this one client that was in the medical field, made $200,000 a year, netted $8,900. And in the last year, 2 years, she's been really freaked out about risk. And beforehand, she had said, I've been invested pretty much like the stock market. And she figured she had about 50% risk. She goes to her 401k, one of the biggest 401k names in the U.S., which you all know it. And she told them, hey, she wants to reduce the risk. And they said, okay, we got you covered. So they reduced it. Instead of 100% stock, they reduced her down to 75% stock and 25% bonds. So they said that would significantly reduce her risk. We did an analysis and we looked at what she had before. And if she had the stuff before, she would have lost 53% if the market went down like 2008. Her significantly reduced portfolio, she still would have lost 41%. So she wants to retire now. Can she go into retirement having a 41% supposedly significantly reduced asset base?
Well, she can, but what's going to happen when the market drops, she's going to be panicked because she doesn't understand, like 99.999% of consumers don't understand what risk really is. We're using outside third-party research companies to figure this out for you. It will give you, within a 95% accuracy, how much you're likely to lose the next time the market drops. If you have a 60-40 portfolio, 60% in equity, stock, funds, stocks, and 40% in fixed income, you have a 38.53% risk factor, which means that the market drops by 53%, like it did in 2008 and 2009, and like it did in between 2000 and 2002 at the tech bubble, you're going to lose about 38 to 40% of your money on paper. Now, imagine that. You say to yourself, okay, what if that happens? We have another drawdown in the market of that magnitude. And let's say you're taking out 5% of income off your portfolio. Let's say you have $2 million, you're taking out $100,000 a year. And all of a sudden that happens. And now you've lost 40% of your money. You're down $800,000 on your $2 million. And if you're taking out $100,000 on $800,000, now you're taking out 12.5 or 13% off your income base. Your money will not last if that happens. And what's going to happen is when you have a drawdown of that magnitude, your reaction in retirement is completely different than how you would have reacted when you were working. Because when you have $2 million and you're retired and the market go down and it continues to go down and your broker says, stay in it, stay in it, write it out, stay the course. There's going to be a point in time where you're going to say to your wife, if you're married, or your spouse, we can't do this any longer, and you pull the plug at the wrong time. You actually move the cash, and you'll never get back to even. So the psychological circumstances that evolve when you have drawdowns in retirement are completely different than how you react if you weren't retired, Dan.
Well, I think to add on to what you said, huge points there, and that is just think about it simply. If you have your assets in a volatile area right now, and we go through more volatility, which I think we're pretty much certain to do for the next several years, and the market goes down 20, 30, 40, or 50%, and you're using your assets for income, just logically, just by intuitively, do you think if the market goes down by that much and you're taking income out month after month, year after year, that you're ever going to fully recover? Do you think that you will run out of money or you won't run out of money? And I think if you just look at reality, you're probably going to say, yeah, I don't really see how I can recover. I know everyone says we will, but I just don't see it. Well, you're probably right. They're probably wrong. And if you think, gosh, I really think my money can run out, even though your advisor, your 401k company saying, oh, you can't run out, don't worry. I think they're wrong. I think there's a high probability. So you got to put yourself in a position to not plan for the best case, but plan for the worst case. And if the worst case works, then nothing worse can that happen. And you're in a great position. So one of the big things I think it comes down to, in addition to reducing the risk, is creating that high level of dependable income that'll last for as long as you live. All of our clients, every single one of them, have been awesome savers. Otherwise, they don't get in front of us because they had to have saved money to accumulate this portfolio that they want to use for income that they're trying to protect. So they've been great savers, and they know how to save. They save, they don't watch it, they keep saving. They don't worry about the market, they hang in there. The issue is then once they get to retirement, or within 5 years of retirement, no one literally has any idea on how they should position their assets to now give them what they need, which is a safe and secure retirement that will battle longevity, battle market losses, etc. So we have to now find assets that will protect the assets that you own, a portion of them, against all losses. Stock market crashes 80%. We got to make sure you do not lose one penny. And think about it. Does that sound good? Yes. What do we get then in return for this as well? Right now, just based on where the economy is, we can get the highest payout rates from the assets we've ever seen in 40 years. So what if you could get 7%, 8%, 9%, 10%, or even higher guaranteed payouts based on your assets for as long as you live, regardless of what happens in the stock market, regardless of what happens to how long you live? What if you can get that type of income, Jim? What's happening then to someone's life?
Well, first of all, people don't understand what that really means. That means if you have $1 million and you're getting an 8% distribution rate, you're going to get $80,000 a year in a distribution jointly if you're married, and even more if you're single.
And what if they get 10%?
Yeah, it may get 10%, may get 11%.
Now they're getting $100,000 a year, guaranteed forever.
Forever. That means even if you ran out of money, they have to pay you forever. Now, you don't put all your money there. You put enough money there to do what we're talking about, to make sure that you maintain your budget, maintain inflation, and have excess cash flow to do the things you want in retirement. You can still put money in the market, but folks, you put all your money in the market, I'll tell you what's going to happen. When the market goes down, you're going to panic and do some bad things. When the market goes up, you're not going to spend money, because what happens when the market goes down? And you have to change the way you're going to retire and how you're going to use your assets.
For more information about Peak Financial Freedom Group or to schedule a consultation, just go to our website, peakfin.com. That's peakfin.com. And thanks for watching.